You look at the headlines, and all they're screaming about is how commercial real estate is dead, absolutely dead. But behind the scenes, there's a completely different story playing out. So let's dive into this playbook and see how the big institutional funds are turning these so-called ghost offices into some seriously high-yield assets.
To really get what's going on, you have to start with this number, 17.7%. That's the office vacancy rate right now in the United States. I mean, think about that. Entire floors, entire buildings, just sitting there, empty. This isn't just some market slump. For a lot of people, this feels like an extinction-level event for the old-school office. And if you're looking for the poster child for this whole apocalypse, look no further than WeWork. The spectacular flameout of one of the biggest office tenants on the planet, it basically poured gasoline on an already raging fire. Their collapse didn't just wipe out investors, it sent shockwaves through the entire system, crushing landlords and the banks that lent them money. And here's why it was always doomed to fail. WeWork's entire model was fundamentally fatally flawed. They had this crazy mismatch. On one hand, they were signing these ironclad 15-year-plus leases, a gigantic liability on their books. And on the other hand, they were renting that same space out on flimsy month-to-month contracts. Oh, and their expenses were double their revenue. It was a ticking time bomb from day one.
And this quote just perfectly captures the disconnect, doesn't it? They were out there pitching themselves as this revolutionary tech company, a physical social network, talking about elevating the world's consciousness. But when you looked at the numbers, the reality was they were just an unprofitable office rental company burning through cash like there was no tomorrow.
So here's the thing. This crisis is so much bigger than just WeWork. You need to know about what the industry calls the wall of maturity. That number right there, $1.8 trillion. That's how much commercial real estate debt is coming due in just the next couple of years. And here's the kicker. All those loans were written when interest rates were basically zero. Now they have to be refinanced at today's much, much higher rates. It's creating this massive, terrifying funding gap.
Which, brings us to the big question. With record vacancies, tenants disappearing, and a multi-trillion-dollar debt crisis on the horizon, who in their right mind would even think about buying one of these buildings? Well, it turns out the answer is pretty fascinating, and it has almost nothing to do with people working at desks.
This is what some are calling the Phoenix strategy. Because rising from the ashes of that old office economy is this huge, almost invisible new demand. See, the AI revolution isn't just happening in the cloud. It needs a massive, physical infrastructure build-out right here on planet Earth. And to really get this, you have to understand this key shift. For years, we've lived in the world of software as a service, or SaaS. Think of tools like Salesforce. They're static, they help humans do their jobs better. But now, we're moving to Outcome as a Service, or OAS. This is a whole new world where autonomous AI agents are doing complex jobs all by themselves. And those agents, they need a ton of localized computing power to function.
And that computing power has very specific, very physical needs. We're not talking about Wi-Fi and a coffee machine. We're talking about on-premise data centers to run all those AI tasks efficiently. We're talking specialized liquid-to-chip cooling systems, high-density fiber, custom computer chips. And it turns out, with a whole lot of investment, you can build all of that inside the empty shell of an old office building.
The strategy here is a classic picks and shovels play. Think about the gold rush, right? The people who consistently made fortunes weren't the guys hoping to strike gold. It was the merchants selling them the picks, the shovels, the supplies. It's the same idea here. This strategy isn't about betting on which AI model is going to win the race. It's about owning the essential infrastructure that all of them desperately need to even function.
Okay, so we get the what, but how are these investors actually pulling it off? This is where we get into the nuts and bolts of the financial playbook. It's all about how you buy the asset in the first place.
And it all starts with a super simple but powerful principle. An asset puts money in your pocket. A liability takes money out of your pocket. That empty, decaying office building with property taxes and maintenance bills, that's a liability big time. The whole goal is to perform some financial alchemy and transform it into an asset that spits out positive cash flow every single month.
And the main tool they use to do this is called forced appreciation. Now, this is not speculation. This is not buying a building and just crossing your fingers, hoping the market goes up. No, this is about buying a problem at a huge discount, actively fixing that problem by converting the building's use, and in doing so, you force the value of that property to go up to match its new high-income potential. You create the value yourself.
So here's how the process breaks down. Step 1.
You buy that distressed, vacant building for pennies on the dollar from a seller who just wants out. Step 2. You reinvest your capital to fix the problem. You convert it into a high-tech data center. Step 3. Bam! The building's value is now based on its new, much higher income. And then step 4, this is the magic step. You refinance the property based on that new, higher value, pull all of your initial capital back out tax-free, and you go do it all over again on the next project.
And this really gets to the core of it, right? This highlights the huge difference between investing for capital gains versus investing for cash flow. Capital gains is speculating. It's a high-risk bet. Cash flow, on the other hand, is about building a business that creates a steady, predictable income stream from essential infrastructure. That's the name of the game here. Now, this all sounds fantastic on paper, right? But it is absolutely vital that we talk about the brutal truth of these projects. Converting an old, creaky office building into a state-of-the-art tech facility is incredibly hard. It's crazy expensive, and it is full of risk. It's a total gauntlet. And the number one killer of these projects? Catastrophic budget overruns. You think it's going to cost you $10 million, but then your team opens up a wall and finds hazardous materials, or there are major structural issues, or the city's zoning board fights you for a year. Suddenly, your actual cost is $15 million. Scope creep, unforeseen problems, they can and often do blow your budget by 50% or more.
So, how do you possibly survive that? Well, there is only one way: a margin of safety. This is the absolute bedrock principle of value investing. It means you have to buy that initial property at such a steep discount, we're talking 30 cents on the dollar, that you have a massive financial cushion, a buffer to absorb all those inevitable mistakes and all that bad luck. If you don't have it, your project is dead on arrival.
And let me be crystal clear about something else. You absolutely cannot do this by yourself. This is not a DIY weekend project. This is a team sport, and you need a roster of absolute killers. At a bare minimum, you need architects, every kind of engineer you can think of, structural, electrical, mechanical, plus specialized contractors and zoning lawyers who know the local game inside and out. Every single one is critical.
But for the teams that can actually make it through that gauntlet, the ones who buy right, build the right team, and manage the brutal reality of the conversion process, well, the payoff is huge. It represents a fundamental shift in what real estate value even means. Just look at this before and after. Before, you had a liability, a trendy office with kombucha on tap, trying to serve fickle startups on month-to-month leases. After, you have a real asset, a piece of critical infrastructure with high-tech cooling, serving autonomous AI agents on long-term, high-value contracts.
And that right there is the profound takeaway. The very role of the landlord is being transformed. It's not just about renting desks to people anymore. It's about becoming an essential utility provider, owning the physical foundation of this new technological economy.
Which leaves us with one final thought to chew on. As we push deeper and deeper into this new economy, we really have to ask ourselves, is the most valuable real estate of the future going to be designed for humans or for the machines we're building?